we talk about real estate syndication, but in fact, you can really syndicate anything. You can syndicate a sports team. You can syndicate racehorses. Like there's all kinds of. It really just comes down to grouping investors with operating partners. And so you have your investment partners, your capital partners, and your operating partners are the people who do the work, whether that's run the baseball team, manage how the horse is taken care of, or like in our case, manage the real estate, purchase, manage, and go through the complete business plan.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi, everyone. I'm Jason Balara, and this is the Know Your Why podcast. Today, I'm excited to be here with Rachel McFarlane. Rachel is our newest team member. She's come on board as our investor relations manager. So excited to have her. Gosh, how long ago did we meet? Like 15 years, something like it's maybe not quite that long time ago in the veterinary world. And then, sort of through fortuitous timing, it worked out well to have Rachel come on board. Rachel, I don't want to put you on the spot, but if there's anything you want to talk about from your background,
No, I'm happy to.
Sure,
yeah.
Go ahead.
Happy to be a part of the LARC team. Very excited. Real estate is definitely not unfamiliar territory to me. My father has always been a investor in the residential property side. And so growing up, I've definitely had just being able to see my dad buy property, hold on to it, flip it, or mostly it's for just long-term investment benefits. So I'm interested to see a different side of real estate and help grow LARC and be a part of this team.
Yeah, awesome. And I guess the idea behind this episode of the podcast was really centered around a lot of the conversations that you and I have been having with investors lately and each other, but just kind of, I think sometimes you get in this world, and the farther you get into it, some of the stuff becomes second nature, some of the terminology that gets used and thrown around, and it's just, I think sometimes we forget, a lot of investors that we're talking to, whether that's in person or via our social media platforms and whatnot. I think sometimes they don't know, they don't have the same background. Maybe they didn't have a father that was an investor, and they didn't grow up in construction like I did. And so all of the terms can be very foreign, and I think that maybe scares people scares them from taking advantage of these opportunities that are available to them. And a lot of times people think, when they think of real estate, they think about that their only option is what your dad did and does. And
Right.
they already have a very busy life and job, kids, whatever it is, and just aren't comfortable with the idea of taking on something and sort of self-managing, and not realizing that passive investing in real estate is available and actually quite prevalent in the world. So we just decided we wanted to do this and almost kind of roll it back a little bit and go, sort of straight from the beginning, to put out some of the basics and really just try to talk through the life cycle of what's involved in a syndication. And we currently have a fund open, which is, and the reason I mention it now is just because there may be points through this where we use syndication and fund a little bit interchangeably, but I'll try to define some of the differences so you can see, as people are making investment decisions, what might be more appealing to them, one over the other. So we'll I just want to put that out there. If I'm using that word and feel free to call me out on it, Rachel, if I'm using that word and it may not be something that someone in a spot that someone might not understand. That the whole idea of this thing is just pure education. So we'll go from that, and we'll interject some of the questions that we've gotten from potential investors, and um, just try to and even maybe wrap through some at the end. But the first question, the big question, is what is a syndication? And you'll see it defined in a number of different ways, but basically, a real estate syndication involves a group of people or a group of investors pooling resources together to purchase an asset larger than one person might generally purchase on their own. And so we talk about real estate syndication, but in fact, you can really syndicate anything. You can syndicate a sports team. You can syndicate racehorses. Like there's all kinds of. It really just comes down to grouping investors with operating partners. And so you have your investment partners, your capital partners, and your operating partners are the people who do the work, whether that's run the baseball team, manage how the horse is taken care of, or like in our case, manage the real estate, purchase, manage, and go through the complete business plan. Syndications provide a way for individual investors to participate in these larger deals and leverage the expertise of the managing partners and the experienced professionals. So everybody has their role in the syndication. Is just kind of a matter of are you in one of the active roles or are you in one of the passive roles? So that's what we're going to kind of break down here, is going through the process of a syndication. And I guess realistically, if you're listening or watching this like someone who is interested in being an operating partner or a limited partner or an investment partner, either way, you want to know kind of what the process is. And so the first thing really that happens is we identify a property or we identify an asset. Again, we'll sort of use those interchangeably because most of what we're talking about here is with real estate. But we identify an asset and we decide, okay, this is something that appeals to us. We do the underwriting. We make sure the numbers work. We make sure the projected returns for our investors are where we want them to be. And then we start the process of acquiring that asset. And the first thing we do is we form an LLC. And the reason we do that is because, in fact, when you invest in syndication, what you're actually doing is purchasing shares of the company that owns that asset. So it's similar to purchasing stock in via the stock market. It's a different way to do it, but you're in fact selling shares of a company that owns that asset. So you have to form that company, which is the LLC that holds ownership of the property. So it's a little bit confusing, but it really just provides for legal protections, especially for the limited partners or investors. And so
And
form that company. Go ahead.
Jason, will you touch on if someone becomes a passive investor in Lark, what our typical assets are?
Yeah, and so typically we're looking at multifamily real estate. Currently, what we're targeting is break them down into classes, but B class, which it ultimately refers to two things. It usually typically refers to the age and also the location. So if the best way to think of it, I think, is kind of start at the top. So A class is brand new, so something that was just built, and almost everything that's brand new is going to be built in a very nice location, right? So that's how people can charge the most rents and therefore create the most value out of that new construction. B class is sort of the next level. So you might go back to um, late 80s, early 90s as far as vintage, and still be in B class, but also refers to that location. So it may not be where all the newest of the new is being developed, but it's going to be pretty close proximity to that. And so you have that sort of nice feel, but not necessarily brand new. And we're also targeting greater than 100 units. And the real reason for that is just economies of scale. So there are certain numbers of units, and by that we mean apartments, certain number of apartments that require X amount of staffing, right? So if we say 100 units requires one leasing person in the office and one um, maintenance person, you still you still need those people if you have 80 units, but you have 20 less units then to sort of cover the costs of their salary and payroll and all of that. So there are that's where the economies of scale come in. At certain numbers, you essentially optimize the expenses associated with it. So if you're buying 300 units, 400 units. Now you might even get better because you don't necessarily need a leasing manager for every 100 units. So if you're at 400 units and you only need 3 people in the leasing office, well, effectively that's one less salary for per 100 units, if you will. So we a lot of times people use that 100 unit, maybe 150 unit as that sort of cutoff where you start to really realize those economies of scale. It's not the only expense, but it's probably the easiest one to explain. Um, and so that's what we're targeting. We have our markets that we like. Specifically, Atlanta is probably where we're most heavily invested. We also like Phoenix, Arizona, and the Carolinas. So in terms of targets, that's kind of what we're looking at from a multifamily real estate standpoint. So once we identify and we've formed our LLC, now we're going to go through the process of sort of creating an offering and an investor summary. And so we get all our numbers dialed in. We start the process of finding financing, of finding who our property management is going to be. Typically, we already know that because we have developed teams and we have boots on the ground. But we're essentially assembling the team that's going to manage that asset through purchase and afterwards. And so then we put together an investment summary, and we're sending that out to our investor pool and seeing who's interested. When you're talking about a syndication for a single deal, a single asset, then you're going to kind of do that all each time. When we talk about our fund, now we have an investment summary that is for our fund in total, and we don't have to create a new legal structure. We create a new legal structure for each property that the fund owns, but we don't have to create a new legal paperwork necessarily each time we purchase a new asset. So it actually saves on some of the expenses in the long run coming through a fund once you start to build up a number of assets in that fund. But as an investor, you're either investing in one single property or you're investing in a fund which will have diversity and kind of invest across multiple properties. So we create our summary of that. We try to make something that is easy to understand and informative for our investors. And typically we'll hold a webinar so that we can sort of get the word out as to what's going on. And then when someone decides that they are interested in all of these things, a lot of the stuff is happening simultaneously. At the beginning, the general partners or the operating partners are doing a lot of different steps simultaneously. We're developing all the paperwork, we're negotiating with the seller, we're arranging financing. Like I said, we're getting that team in place. At the same time, we're reaching out to investors, and the investors are evaluating the opportunity and deciding that's something they're interested in. Once they do that, the best way really to kind of find all the information in one place is to go to our website. And through there, you can click on the deal room. There's a big deal room button. You can click on that and go to and find out everything you need about that investment or that opportunity. And if you decide it's something you're interested in, then you kind of follow through the steps. You'll see what's called a private placement memorandum, or a PPM. It's an extremely long, kind of scary legal document that lists the potential risks, because this is an investment, lists all the potential risks kind of over and over again. I'm not honestly not sure why it has to be in there like 5 times, but I think it's really all of this is governed by the SEC, and so there are specific guidelines that the PPMs have to follow, and we have a specific syndication attorney who writes that up for us and kind of guides through that process. Excuse
Um,
me. And,
I
and
think it's probably good to talk about and mention just that this part of the process can be um, a lot to read through and go through, and that's where you or I would come in. And I mean, you especially going through this document with somebody and being able to answer any and all questions is something you are available to do because someone might not be familiar with a PPM.
yeah, exactly, and that's exactly true. We can, we want the whole point, in bringing you on is to make our investors to make their experience better. And I know, we both come from the veterinary world, and I'm sure this is true in other professions as well. But in general, you get caught up in life, whether that's your work, your family, your kids, all of that stuff, and maybe you didn't learn a lot about this stuff. I didn't know about all this stuff, 5, 6 years ago. Despite having been involved in real estate and construction since I was a teenager, this is just a different side of the coin, and the idea is for us to make this as user friendly, easy, take away the limitations that come out of fear, right? Like, let's address all that stuff right up front, and that way people can invest comfortably and build for their financial futures, because I 100% believe in the vehicle for building for your financial future, and wealth growth and things like that. So yeah, you're absolutely right. If it's sitting down and going through the PPM line by line with someone, with a potential investor, we'll do that. I've done it. It's tedious, but it's important that you understand. And the first time I ever saw a PPM, the first investment I made in a syndication was as a passive investor. It was not one of my own deals. It was someone else. One of my mentors. I trust her completely. I wasn't at all worried about investing with her. And then I read the PPM and I was like, wow, this is serious. Like, this is heavy stuff. And it's kind of ironic because, when people want to invest in real estate passively, they get this 70 plus page document about all of the risks. But if you want to invest in the stock market, all you got to do is get a Robinhood app, and you can put as much money in there as you want. There's no, like, no legal process. You don't have to um, prove that you're accredited, or whether you are or are not accredited. None of that is involved in investing in stocks, and there's risk in any investment. So I don't frankly don't understand why it's different. But long story short, we are here to help in all capacities, wherever, whether it's before you invest or after you invest. I think one of the big beauties of these types of offerings is the PPM is called private placement memorandum, because that's what this is. You're investing in a private placement. Well, what that means is you have access to me and my team. You have access to us, and you get to call us with questions and things like that. I'm 100% sure you'll never get Tim Cook on the phone if you invest in Apple. So it's to be provide a more personalized service for people, and with an excellent investment vehicle. So that's kind of the idea. And to round out, sort of what happens as a passive investor in that, sort of beginning stages. Once you go through, you read the PPM, you're comfortable, you go ahead and sign. The next thing is you're just going to get, essentially, it's going to automatically send you wire instructions, and then you wire in your capital to the bank account that's associated for that specific LLC, and then we close the deal, whether that's, via single deal syndication, or through our fund. Anything to add in there or ask there, Rachel, before I kind of move on?
I think one of the questions that we've gotten is when somebody invests from that point in time, how often are we in communication with them before the assets go live, essentially, or before distributions start? And is there
Yeah.
a time frame that you set from the beginning?
Yeah. Great question. And it, the short answer actually is it kind of depends. And I'll explain that. So for one thing, if I believe people should invest in real estate, I think it's a great investment vehicle. They don't have to invest with us. There's other people doing this, and if our investment thesis doesn't fit what they want, I'm happy to make introductions. But at the end of the day, the answer to your question, your specific question, should be all defined in the offering summary or the offering memorandum and also in that PPM. So it's going to talk about things like what the communication schedule will be. It's going to talk about things like, when is this deal supposed to close? If you're investing in a single deal, that's going to be different potentially than a fund. So if you're investing in a single deal, typically it's a fairly quick process, like maybe 45 to 60 days. So you're going to get a deal. So the operator is going to get a deal under contract. You're going to decide whether or not you want to be a part of that deal, and you're going to have to invest fairly quickly to get in there and be a part of that deal, and then it closes. With a fund, it's a little bit of a longer process in that the capital contribution portion is open longer. And also, we're continuing to buy multiple assets through within that fund. And so the hold time still, whether it's a fund or it's a single deal, should be defined in the investment criteria. And for us, for our fund, it's 5 to 7 years. That's the total hold time. Distributions typically will start 3 to 6 months after purchase of whatever property, whatever acquisition you're trying to do. That's within our deal. A contrary example to that would be, say you were investing in a development deal. So you're going to invest in a ground up build of an apartment building. There's not going to be any distributions probably for 2 to 3 years because that building is being built and not making any money yet. So the distributions are based on the income that the building or the asset is producing. So, and that's okay. People do development deals all the time, and they're good deals. And you're looking at overall returns, not necessarily what distributions I'm getting during that initial hold time. So you have to look at what you want to get out of your investment, and then you have to look at the investment summary for the deals that you're looking at. But ultimately, within our fund, we're doing monthly distributions. Typically, you're going to see either monthly or quarterly. It just depends, and you're going to look at that deal summary, the offering memorandum, to see what the expectations are there for distributions. And like I said, our hold time for the fund is 5 to 7 years. Does that answer kind of what you were getting at?
Yeah, I think the only other question that might come up is if in our we have a fund right now that we're working on, and we have an investor interested and puts forth the capital this month. Um, do their funds sit there until we actually close the deal when it's expected, or when we like, is there a year-long wait before they start to receive distributions? And do they get that information in the PPM?
They definitely will get the information in the PPM. It should be in any PPM. So our deal
Okay.
or someone else's deal, those types of things should be defined, even to the point of specifically in a fund. So people get a little bit hung up on this, but if you look at it from the actual time horizon of 5 to 7 years, what happens right at the very beginning is that fund has to pick up momentum, right? So in the beginning, people are investing at different time frames. In the beginning, assets are being bought at different time frames. When you invest in a fund, depending on when you put your money in, it may or may not go directly into a deal. usually it's going to go into a deal within a month or 1 to 3 months, let's say. There are usually provisions in the PPM of what's happening with that money in the meantime. You can do it can be put in a money market account, so it's gaining interest. But rest assured, like if you invest in a fund, you are still, even if you come in, like for example, in our fund, we already have the first asset in the fund. People who invest moving forward, they're still investing in that initial asset. And people who invested before are investing in the future assets. It's just right
Mhm.
now we have one asset in there. And so the distributions are based on the profit that's coming to the fund from all assets combined. So it's a thing that people get hung up on in the beginning, but like in reality, 1 year into the fund or 2 years into the fund, like it doesn't matter because everything, all the money should be in and it should all be, all the assets are probably acquired. There are different types of funds. There are evergreen funds where that cycle just keeps going, where they're always raising capital and they're always purchasing new assets and it just keeps going and you get your distributions based on when you come in and it just kind of rolls over. It makes the bookkeeping and the accounting a little bit tricky on the back end. Like it's a lot harder to manage those things within a fund than it is in a single deal. But that doesn't matter for the investor. They don't have to do that. That's the whole point, right? They're, as the passive investor, they don't have to do any of the additional work. We do that. So when people invest, there are different ways to structure a fund. The other thing that you can do is essentially create a almost like a capital call type of situation where if someone signs up to invest in the fund, they don't necessarily have to put the money in then, but the minute you send them a notification that, hey, we need the funds, they are legally then required to send the funds in. And I actually think that's a little bit scarier because if you are thinking like, oh, maybe they won't acquire anything in the next, 3 months, 6 months, I'll just hang on. And then you're in that type of situation. And then a month later, someone says, okay, you've got to put your money in. Now that's a little bit of a tricky thing. So I think like the idea of a fund, the funds are not successful if we don't buy assets. So the whole idea is to continue buying assets. So it generally, we don't expect people's money to be like sitting around waiting. But you can't
Yeah,
buy
I think,
assets without money.
of course. And that's where all the communication comes in, right? It's important to
Right.
be able to have
Yeah.
people who are open to communication at any point in time, like myself or you,
Yeah.
and and then just knowing that the questions can be asked, and the other point you made, which I think is good to refocus on, is it's the distributions aren't necessarily the main thing to put the focus on. It's how long is the whole time and what's our goal at the end of that whole time, because that's really where the real financial gain can come into play, right?
Yeah. It's the long term. Real estate is a get rich slow, not get rich quick. And so what happens in the first 3 or 6 months of an investment, like generally has no bearing on how things end up. The other thing just to mention here in this within our fund and other people do this in their deals too, but we have we have a preferred return, which is a preferred return. There are no guarantees when it comes to investing, but a preferred return means we pay, and our preferred return is 10%. We pay 10% to the investors annually before we Lark Capital as a company shares in any of the profits, right? So investors are going to make 10% before we ever see anything. And so what that does is when you invest your money, that's when that number starts calculating, right? So it's a cumulative thing. You probably won't be getting 10% annually in the first 6 months, maybe even 12 months, but that there's a catch up over time. But if your money's not invested, that clock hasn't started. So although you may not receive a distribution right away, that calculation is happening right away,
Right.
right? So you are in fact earning something for it to be there. Like you're on the clock essentially as far as returns go. So I think maybe that's another way to explain like the benefit of not just sitting back and waiting, because I think that's one of the biggest problems I feel like people make, or biggest mistakes, is sitting on the sidelines for too long, and then they miss the boat. So it's just, but you're right. The communication is the most important thing, and sort of we I guess we can talk about our sort of reporting and communication, and this goes along with the operation and management of the property. Once we've acquired the property, then we go into the whole process of asset management, and that's quite frankly an entirely new episode or a different episode. And it's not what our passive investors are going to be doing. That's the whole point. They don't have to do any of that part. We do that part, and then we make continued communication and reporting to let them know exactly what's going on. So we have a monthly newsletter, or sorry, a weekly newsletter that goes out to all of the people on our investor list. Our investors, or our in our database, our investors are getting monthly updates on the properties that they are invested in, whether that's the fund or any of our other deals. They're getting monthly updates on those. And again, every single one of them has my phone number, my email. They have all of our stuff. It's all there for them to contact us, so they can call, text, email anytime, and we can talk about it. So I mean, a lot of them are people I know, and so I talk to them anyway. But it's kind of a the opportunity to communicate is there, and I guess repeating what I said earlier, that's one of the biggest points of adding you to the team, is so we can make that communication even better, even more robust, even more user friendly to investors. So that's the
Yeah.
whole goal of building this team out.
And from my perspective, I'm a big talker anyway, so I'm happy to always talk to anybody, but I think I like my foundation is built on asking questions and feeling comfortable with anything I put my time and energy into. And I would expect that of the people that we work with as well, the investors. And so those are the types of relationships that I want to have and we want to build as part of this group. And I think that's a really important thing as well. Like it's the people you work with, and this is a different type of investment entity than stocks, as you already kind of discussed. And so I think when you're, putting as much capital as you are or could be into a fund like this, it's important to be able to have those really comfortable relationships. And it's important to be able to ask those questions. And you're exactly right. Like I appreciate that in my own life and in the things that I invest in, whether it be a fund directly, what we're talking about, or a work in general, or my investment in my kids, right? Like all these things are important.
No, 100%. And I think it's just, well, here's a good example. We're coming up on tax time here, and well, specifically important to know is, if you are investing in real estate, even as a passive investor, you want to make sure that you have an accountant or CPA that understands how that impacts your tax treatments. I'm not one of those, but I have definitely gotten some questions from some of our investors around tax time, and it's happening again now, where I would have assumed that any CPA would know these things, but they don't. And so I've helped some of our investors with how to manage some of their. Um, I don't file their taxes. I don't do any of it. But if they're hearing things that I know are probably not correct or not in their best interests, I have directed them to someone who can help them, who has specific um, knowledge and expertise in the world of real estate investing, because it is different, and there's a tremendous amount of tax benefits, but you have to know how to take advantage of them, and take advantage of them in a way that's not going to end you up in tax court. So there's that stuff is what we try to be there for. Again, I'm not a CPA, I'm not an attorney, but I have those resources and we can help you. Like people can invest through retirement accounts, but it has to be a self-directed IRA. I have people I can direct you to that do those things, that set up self-directed IRAs. And I would direct you to them because I've done it, not because I'm just like sending you to some random person. I'm sending you to the people that I know and have relationships with and trust. So it's that's another, I think, big benefit in the passive investing world is you get to leverage those relationships of the people that you're, kind of working with and investing with. So I would say the sponsor or the operating partner is probably more important than the actual deal itself. Like, some people have specific asset classes and things like that that they want to be invested in, but really at the end of the day, you want to be investing with someone that you know and trust, and that they're going to be able to do what they say they're going to do, that's what they're going to hold at the highest level, is that we will do what we tell our investors that we will do, and just kind of back that up along the way, because markets change, things go up and down, and we still have to operate when the market is down. We will be happy when markets are up, but we still have to operate when they're down. We still have to protect our investors when they're down. So that doesn't change anything for us in terms of our approach. Um, we talked about, kind of the communication. We talked about distributions. We practice a value add style strategy. Value add just refers to finding assets that we can purchase where we can um, force appreciation rather than just relying on the market to do it for us. Market appreciation is phenomenal. Sometimes that's going to help you more than anything you can do from a forced appreciation situation, but you also can't rely on it. And we've all seen that stuff over the last handful of years where appreciation went up crazy, and then it came down because interest rates went up, and it'll go back up when interest rates. I mean, that's just part of it. But those are things none of us have control over. We have a we have control over which debt structures we use, which is an extremely important part of the process when it comes to acquisition and things like that. But we don't have control over what the market does, and so we like to find things where we can force appreciation through our value add strategy, which basically, just in a nutshell, comes down to better management, which means, optimizing the leasing and reducing expenses. And then also we like to do it through construction, because that's my background. I've been getting my hands dirty since I was a teenager, and I enjoy that piece of the puzzle, and kind of how we can make this not only a nicer place for our residents to live, but something that our investors can go and if they want to visit. And by the way, you can do that when you invest in these types of things. You can go, if I'm in Atlanta, you want to meet me there, I'll be happy to show you around. Like, you have those opportunities to, when you're invested in a syndication or a fund. But again, appreciation, we're looking for ways we can force it, and then we time our exit based on the market. So we either you're gonna and the strategy might differ per asset, but you might consider a refinance, or you might consider a sale, depending on where the market is. Maybe you've kind of maximized the value out of your asset, and now it's more of a cash flow play, and there might be specific investors who want to purchase at that point. Everybody has a different plan, and that's why I say, like, if someone isn't excited about our investment strategy, that's okay. Like, there's other ways to do it. There's a lot of ways to be involved in real estate, and we can still help them find those things, and we can still help them learn about them, even if they don't necessarily want to invest with us, and that's okay with me. Um, we either refinance or we sell. A refinance is a nice option if you've had a significant drop in interest rates since your acquisition, but it doesn't necessarily always go that way, right? If you're relying on a refinance and rates go up, you're probably in trouble. And so it's kind of there's places where that comes into play. A refinance, like a cash out refinance where you can harvest some of the equity, is a really nice scenario because then you can return investor capital and it's tax free. Refinance is not, there's no tax on a refinance event. So there's a lot of um, benefits to a refinance, but it just has to work. It has to work with the strategy that you've got in place on that specific asset class. And typically you're going to have that, you're going to try to model that out before you even purchase it. What's my strategy here? What debt structure is available to me? How long are we going to hold this, right? If we have 7 years if we have a loan that's 7 years long, and we're going to hold it for 6 years and it's a good loan, we're probably not going to refinance. We're going to sell it before it gets to the end of that kind of. So I mean, there's different ways to do it. When we have a capital event, it's referred to, which is either a refinance or a sale, then is when all that bookkeeping and accounting comes into play. But that's when we calculate investor returns. And so again, if the preferred return has not been met up until that point, that's the first stop. That's the first calculation in terms of returns. And so if our fund only made 10%, which is actually pretty good, if our fund made 10%, our investors will get all of that. And we won't get any, and we will have done a lot of work for nothing. But again, it's not nothing because investors will have won. Also, I invest passively in all of our deals, so I will get something out of it. But the point is investors come first, and that's always going to be the way. Um, but when we have a capital event, again, if it's a refinance, you're getting a portion of your invested capital back. You get to continue to receive distributions as if you had all of it in there. So it's a nice, it increases your cash on cash return at that point. And then if we sell, then we take the sale proceeds and we divide them up based on your ownership percentage in that company. Now, I don't want to get into a long tax discussion, but there are tax implications when you sell. A refinance is a tax-free thing. Tax implications when you sell. Fortunately, passive investing is taxed at a significantly lower rate than earned income, like 50% versus 5, 10, 15%. So your tax burden would be much lower. But when we have an exit, we also have the opportunity to do something like a 1031 exchange, and you can take those funds. If you don't want to realize the tax burden at that moment, you can roll them into another deal and continue the cycle and just continue to make money that way without having to pay the tax on it. So full disclosure, it doesn't go away forever. Eventually the taxes become you'll if you exit, you will have to pay taxes. There is probably even shouldn't bring this up here. It's a whole different discussion, but there is a strategy that basically you just keep rolling it over until you die, and then that tax burden goes away. These are all strategies, I will say, that can change based on the tax laws. So there was talk of doing away with 1031 exchanges. There has been talk of, actually, the bonus depreciation was supposed to be phasing out, and then now they're reinstating it. It's in the Senate to be voted on to reinstate it. So things like that, policies change, but ultimately, most of the people in politics understand the value of real estate investing, both as an investor and as a um, uh, someone who needs a place to live. We're providing housing. They see the value of those things, and so most of the time, cooler heads prevail, and those rules don't change too dramatically. And real estate is still a very tax advantaged vehicle to grow your wealth within. So, I feel like that's for the most part again, we could probably break down each of these topics and talk about them for hours, but for the most part, that is kind of the life cycle. And the fund is not that different. It's just that it's invested in multiple assets. So you would have multiple potential exits within the life of the hold. Or, yeah, within the life of the fund. So that hold period of 5 to 7 years for our fund, we're not going to buy all the assets and then sell them all on the same day. It's going to be, one might sell after 3 years, one might sell after 5 years. Like it's sort of a rolling process. So that's how it works. But as we do that, then it's the same process. We still take the profits from that deal and we distribute them to investors.
I think there are a couple points in there that you made that are important to hit, go back and hit on. It's one, that you are investing right alongside our investors. And I think that's important to refocus on, because that um, brings a certain faith in the process, and the knowledge that you trust this process as well, and you're putting money up just like another investor. And and then the other thing is that the hope is, we've compared in this conversation the benefits of this to stocks in a way, but the hope and is that this is you you've you receive a much bigger, hopefully, advantage or return in a process like this by investing in a process like this. And then that the tax benefits and the fact that this is taxed in the long run is, yes, inevitable, but the hope is that the returns are at a scale that's much larger, and that the progress that these funds make is at a much larger scale than what our stocks are typically doing. And so I think those are two kind of important points, is that the advantages and the progress of these investments can be much greater than what our traditional investments or stocks typically do.
Yeah, and that the point about, comparing it to stock, again, that could be like an entire another several hour long conversation, but the point is they are very different vehicles, and I believe that real estate is for a number of reasons, probably the better vehicle. But I'm not against investing in stocks, and I actually invest in stocks. But so many people invest in stocks, especially through like retirement accounts and things like that, blindly, and they don't actually know what they're investing in, what the fee structures might be, like they don't know these things. And so to me, it's the challenge is that you're doing something with your money, that you're just doing it because that's what is kind of said to do, and you don't necessarily know what the opportunities are that are available to you as alternative options, diversification plays, call it whatever you want, just another way to grow your wealth. And like I said, I think in a better, um, in an advantaged way for a number of reasons. But um, stocks are fine. I have no problem with them. It's just that's kind of a different, it's a different strategy. The point about, me investing, I mean, honestly, it's a little tongue in cheek here, but I think sometimes my wife wishes I didn't believe in this so much. And because the one knock on real estate, or the one that I think people will bring up here, I've heard from potential investors, is just the illiquidity of it, right? So one reason I think people like the stock market, or they have their Robinhood app or whatever, is it's like they can just sell anytime. You can pick it up if it's if it's between trading hours, you can sell. That's great as long as you're not doing it emotionally, and most people are doing it emotionally. So I look at the illiquidity of real estate as a good thing, that you can't make those rash emotional decisions, and because you don't lose any money until you sell, right? You don't make any money until you sell either, right? It's all on paper with stocks or real estate. But if you can be rational about it and ride through the market cycles, you're going to be fine. That's what I just sort of joke, because sometimes, like I said, maybe my wife wishes I wouldn't put so much money into our real estate deals, but I I look at all of this, like I said, as a very long-term outlook and what it means when I'm gone. And we've talked about this. I've talked about this on the podcast. I actually think definitely by the time this one airs, my episode on creating a billionaires out of my children through passive investing is going to be out. But the whole point is we expect in these life cycles of these as a passive investor, we expect to roughly double our money every 5 years. That's in general, that's the expectation. It may take 3 years, it may take 7 years. But around that, and every market cycle, every deal is going to be a little different. But roughly, if I look at, sort of where I am now and my kids turning 40, 50, 60, the number of times that money can double between now and then and what that does to whatever I get invested right now is just mind-boggling. And so I have very much approached this as I don't have to do this forever in the sense that I'm going to put as much as I can in, but the more I get in the beginning, the better that's going to look in the long run because it starts that clock. And same thing I mentioned with the preferred returns. If you're when it comes to investing, your biggest weapon is time. And so if you're just waiting to invest, the clock hasn't started ticking. Once you get invested, it starts ticking, and so you're moving the needle towards that doubling cycle if we're talking about real estate. So that's why one I'm not gonna put a deal out there that I wouldn't invest in. So that's just why wouldn't I invest in my own deals, because it makes sense to me that I like those deals, but I wouldn't do that to I wouldn't I'm not here to sell. I'm a terrible salesman, in fact. Like I'm not here to sell. I'm here to provide opportunities in a vehicle that I very much believe in. And if I didn't, how am I going to put that out to investors? Like that doesn't make any sense to me. So I will be invested in every deal I do, and I oftentimes might be the largest investor in every deal I do. So we'll I'll leave it at that. But yeah, those are, I think, important points for people to understand, uh, and realize, like, we really are in this together. Like I'm not just trying to sell a product. I'm literally we're trying to grow something together.
Yeah. I think the other really great thing would be is the hope to turn this into a graphic so that um, folks can actually see this and
Mhm.
have something to visually refer to during the process. And it may not. I mean, I'm a visual person, but someone else might just already know the process well enough that they can ask questions, on a whim. But if we can, we'll pull a if we can, we'll pull a graphic together so that that's available in the future.
Yeah, yeah, we're working on that. We'll have and a lot of this information it's out there, right? It's I've talked about probably all of this in bits and pieces through the podcast. We've got a lot of this on our website in the uh we have blogs there. Like there's a lot of it there, but I did just want to kind of roll it back, take a step back, and I don't know, just kind of redefine everything for people that are coming in new. Right now they can listen to this podcast episode and say, okay, here it is, like we talked it out. Also, like, we can point people to this podcast episode, and we'll create more content out of it, short form, and so that it's out there. And I think a lot of this is just education. It's just about learning what's available to you. So um I think that's probably a good point unless you have any other questions that you can think of that you've heard.
No, I'm very impressed that you were able to squeeze in as much as you were able to in the last 50 minutes. So impressive.
Well, again, it's the main point here is maybe the big take home for this is we're here to help you, both of
Exactly.
us. And thank you for joining me, and folks listening to this episode. um, you can find us. Our website is larkcapital.com. You can email either of us It's jason@larkcapital.com or rachel@larkcapital.com. Anybody on our team, you can reach out. I think um, uh, there's also the info@larkcap, but like just email us directly or find our website. We've tried to make it as user friendly as possible. So it's something that we are passionate about and believe in very much, and it's just about getting the word out there. So um, for Rachel, first of all, thanks for joining me today.
Of course.
And folks,
I think the weekly newsletters too are a great place to start. If no commitment necessary other than a weekly newsletter, it's a great
yeah,
way to learn about this process and investing in general. So,
yeah, and follow us on social media, get on our newsletter list. It's we're just trying to put as much out there and as possible in terms of information for people to understand, but we also recognize at the end of the day, you're going to probably want to have a call with one of us before you invest, and that's great. We would love to have that discussion and see how we can help you and see if we're in alignment. Maybe you have a different goal set or strategy that I can point you to someone else that can help you with that. That's okay. Or maybe I can help. I mean, like I said, I've been on the construction and residential side of real estate as well for a long time. So I've definitely talked to a number of people recently about, they're talking about, putting a ADU on their property or things like it's whatever. I like real estate. I like talking about it. So just don't be afraid to reach out. So thank you all for listening today. We really do appreciate it.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?